the way I like to do these sessions,
there you go,
is really, I have some things that I'll talk about broadly and generally in terms of entity structure. What does that mean from a tax perspective? What type of structure do you want for your real estate? What type of structure don't you want? What deductions are available to you? And then we transition that into Q&A, because I truly believe that the value really comes from answering these specific questions that you all have, because I could talk tax and IRS stuff all day, but that's not what we're here for. So to begin, let me get a quick idea. It looks like we have a good 13, 14 people on the call. Let me get a good idea of where everyone is with respect to real estate. Are most of us on the single family side? Are the majority on the multifamily side? Is it a huge mix of both with some commercial sprinkled in there?
I think it's majority multifamily, but there is a mix. Everyone has their hands in other stuff. Some people come from single family and transitioned into multifamily. Some people do have some commercial, but majority is multifamily.
Okay, perfect. So whenever we're talking multifamily, whether this is small multifamily investments like 4, 8, 16, 32 units on into commercial multifamily, which is where you typically have syndications when you're doing 100, 200, 400 unit projects, the entity structure really sets the foundation for the tax strategy. I always tell folks, how you make your money determines how that money is taxed, and how that money is taxed really dials itself into what type of structure you will set up. So generally, what you will see is that real estate does not typically fall under the scope of a corporation. I think many of us are using either LLCs or a partnership or something of that sort, but very rarely will you ever see real estate under the guise of a corporation unless there are specific reasons for doing so. And when I mention corporation, we're specifically talking about an S Corp or a C Corp. And the reason that we don't put real estate under those, especially when they're closely held assets, that being smaller units or even the multifamily units, is because it's not very tax friendly, because real estate typically kicks off a loss. And when you have losses that large, especially when we get into larger multifamily projects, there are limitations on how much of that loss you can take when it's trapped inside of these corporations. And it's not easy to move those in and out, especially when we talk about transferring wealth to the next generation or even selling the assets. And so from a foundational perspective, typically, and truly from a tax perspective, we like to see real estate inside of an LLC taxed as a partnership, or some iteration of that sort. Now, the entity part, the attorney sets that up, we get the foundation set, and there are typically going to be 1 or 2 layers to this. And those of you that have done syndications, you've seen this model, but those that are doing smaller multifamily investments, especially when you step out of state, typically we're looking at a 2-layer or 2-entity kind of a structure. And basically what that means is you're going to form an entity at the state level, the exact state that the asset is in. So let's just say you reside in Maryland, for example, but you purchased a multifamily property in Cleveland, Ohio. It will behoove you not to form a Ohio specific entity to make that acquisition. And then if you want, you can have a holding company that's a Maryland-based entity, or perhaps Wyoming or something of the sort, that owns the Ohio entity. And the reason we advise that is from a tax perspective, each state is going to have their own unique nuances in terms of state tax, state compliance, and things like that. And you don't want to jumble all that up inside of a master entity that owns several different properties. So that's going to be a key thing to consider as well. And the final thing is understanding that real estate produces losses, sure, but real estate is not just an investment, it's also a business. So as we're looking at and I'm going to break all this down into more detail here, but as we're looking at the tax strategy behind it, you also have to understand you effectively have a business. So it's appropriate to run reasonable and customary business expenses through that real estate related entity. It does not all have to be exclusively real estate. Said differently, if you have something as simple as a single family investment in a particular area, state, or whatever on into the multifamily side, things that people typically forget to include as a part of their tax strategy and their deductions: travel. That's travel to and from that property, to visit, to check up on it, to do all kinds of things. That's also travel to and from Home Depot to grab supplies for repair. That's travel to and from the post office to mail things off. You want to keep track of the mileage that you're accumulating relative to that real estate related business. Miles are 56 cents per mile. 10,000 miles, that's a $5,600 deduction just waiting on you. And of course, if you drive more, then more miles can be written off. If you drive less, then it's a little bit less. So between mileage and just general auto expenses, that's one that people tend to leave a lot of money on the table. The second is with respect to depreciation. I think all of us generally understand that we take the purchase price of the property, we divide that by 27.5, and we get a depreciation deduction every single year. Well, as you get into larger purchase price or even larger multifamily projects, you can start to accelerate that depreciation, meaning you don't have to stretch it all over 27.5 years. There are tools, and I'll talk about one in particular, that you can use to pull a huge wave, 20 to 30% of that depreciation, and drop it right away in years 1 and 2 of owning, of acquiring these properties. These are specifically called cost segregation studies. And if you're in the larger multifamily area or commercial area, you've probably heard of these. And if not, you certainly want to familiarize yourself with them. But even if you're on the single family side, if you're purchasing high value single family properties, a couple $100,000, these cost segregation studies may be valuable for you as well. Just a very broad example. Let's assume we have a $1 million purchase, right, of a 16 unit, 32 unit, or something like that. Under normal circumstances, you take $1 million, divide that by 27.5, and you get a pretty decent tax deduction every single year. That's your depreciation deduction. But when you implement one of these cost segregation studies, the engineer basically comes in and they say, hey, there are components of this building that will not last 27.5 years. We understand that. So we're going to segregate those pieces out, hence the name, cost segregation. We're going to pull those pieces out and change their useful life from 27.5. We're going to change them to either 5, 7, or 15 years. And under the current tax law that went into place in 2018, whenever you have an asset that has a useful life of 15 years or less, you can accelerate that depreciation and take the entire deduction right away in year 1. So if you think about $1 million building, and if you're able to segregate 20% of that, right? Let's say we're able to pull 200,000 of that into the first year. You've just exponentially increased your depreciation deduction right away in year 1. And the beautiful thing is, if you, and certainly a lot of this depends on timing and purchase of the building, but if you have other passive investments or other passive income, you've just created a way to indirectly offset that passive income. And furthermore, and we can talk more about this as well, if you qualify as a real estate professional, you just open the door for a lot of that to flow through and potentially offset income from your other business and or your other job. So I'm going to pause there just for a second to see if that sparked any additional questions before I go into some of the other key areas for real estate investors.
Just knowing the group that's here, I don't want to assume that no one has questions. I think we all kind of have that basic level stuff. But yeah, don't forget to don't be scared to pull the punches. Like, don't pull the punches. I mean, like, this group is super like high level, and we want the in.
Perfect. Okay.
The dig deep, go high level. I mean, not high level. Go into the trenches. We want the dirt.
Gotcha. Awesome.
I have a question.
Go for it.
The tax law that you mentioned, the 2018 tax law that allows you to take 100% of that deduction, is that expiring at some point in the near future? Is that something we should be thinking about? Do you think it'll get extended?
Great question. That does expire in 2025. It may be 2026, but here in the next 2 or 3 years, that does expire. Given the current administration that we have, I think there's less of a chance that is extended. There will still be bonus depreciation. It just won't be to the extent of 100%, and it also won't be unlimited. So I certainly expect them to not renew it because their whole goal is closing the wealth gap and whatever other their priorities are. So I would expect that they're not going to renew that one. So it certainly is something that you want to take advantage of now. And while we're talking about real estate, because that's specific to this group, it applies to assets if you have other businesses as well. So if we think about like the 6,000 pound limit on our vehicles, if we think about large equipment purchases, all those things, you're able to accelerate that depreciation now. 3 to 4 years from now, that could potentially go away.
Got it. Thank you.
Hey, Larry, I had another quick question. Not to get too detailed, I'm actually writing some information about the cost segregations and depreciation. For your example there, you said $1 million. That initially, if you didn't do cost segregation or anything like that, the $1 million, you're going to have to break out the building and the land, right? Because land, the price value of the land is going to be zero depreciation. Is that correct?
That's absolutely correct. Yes.
Okay, and then cost segregation further breaks out land contents, land improvements, and the building, right? Okay.
Absolutely, that's correct. Yep. Yep. Perfect. And in some cases, when you have some of these acquisitions, or because you can do cost segregation studies after you've made the acquisition, and if land value isn't immediately available, what I've seen most of these engineering teams do is they'll take somewhere between 10 to 15% of the acquisition price and allocate that to land. So just kind of gives a roundabout figure. Okay, perfect. So
Larry, can I ask you a
it.
quick question as well?
Yep.
All right, perfect. So I'm using the cost segregation strategies on smaller multifamily as well as larger multifamily. And as I'm implementing this into the game plan, it's breached a couple of other questions I've had from an accounting perspective. So for example, I was using one LLC as a parent LLC for many years, but earlier in 2021, I created a new company name. I created a new entity. Is there a classification called Entity Classification Election, ECE, which basically identifies the new entity to the IRS? And does that allow me to still take advantage of items like mileage and whatnot as a real estate professional full-time, as long as I alert the IRS in a certain amount of time? Or do I have the whole year to, as long as it's before the fiscal year?
Yeah, great question. So when it comes specifically to ECE, there are two subforms that you will use, and this depends on what type of election you want to make. The first subform is called Form 8832. That's alerting the IRS that I formed this entity and I want to elect for it to be treated as either a partnership or a corporation. Usually, again, for real estate, you're not going to elect corporation unless you have a very specific reason for doing so. And so that typically would be a partnership. The other entity election form is called Form 2553. That's the form you will use if you want your entity to elect to be treated as a subchapter S corporation. Again, not very useful for real estate, but if you have other active businesses that does products, services, goods, and things like that, the S corporation could be useful for you. And then yes, you can still take advantage of general administrative expenses, mileage, and asset purchases, office expenses, all those things that we typically talk about. And those are relevant write-offs to the date that you actually, for that specific entity, they're relevant to the date that you actually formed that entity. So for example, if you have very large expenses from January and February, but you didn't form the entity itself and make that classification until, let's call it August, then there's a weird accounting that needs to happen to either account for those expenses, or they have to be separated and reported on a different schedule than your actual entity itself. So your CPA will work through those nuances to make sure that they appear in the right places. But that said, with both of those forms, if your entity was already in existence, there is we call it a revenue procedure, where you can go back and retroactively elect for that entity to be treated as such, back to the date of formation. So said differently again, if you formed your entity March 1st, and here we are in August, there's a late election that you can say, hey, I want this entity to be treated as a S corporation effective March 1st, date of formation. So you do have those options to make late elections.
Larry, thank you so much. That was extremely helpful and exactly in line with what I was trying to understand, because I don't think I realized that you had to elect that right after you formed it. I thought maybe I had the whole year, but it is retroactive, and I'll speak with my CPA. So thank you so much for that. I appreciate it.
Yep, absolutely. Absolutely. No problem. No problem.
Hey, Ray,
So-
I got a quick
Yeah.
question.
Mhm.
It's about the recapture when at sale. And let's say I did bonus 100% bonus depreciation on the year one, and after 5 years, the recapture portion of it, I heard that it's not going to be 100% you took out, and somewhere around the 25% cap at. And what are the implications for limited partner? I mean,
Yeah,
it all
great.
depends on case by case, but
Yeah, it's certainly case by case, but that's a really great question, because while we get super excited about cost segregation studies because they give us the immediate deduction today, if you have a short hold period, a couple of years, and most indications are kind of a 5 to 7 year window. Some are even shorter than that, but you will certainly run up against what's called depreciation recapture. And basically, the IRS is saying, "Hey, we gave you this huge depreciation deduction in these prior years. Now that you've sold that asset, you no longer have it. We want to recapture a portion of that." And so there's a calculation where they look at the gain that you have from the property, the depreciation that you took, and your adjusted basis. And there's a portion of your capital gain that will be treated as depreciation recapture, and a portion that will be treated as long-term capital gain. And you're absolutely right. The depreciation recapture, it's taxed at what's called your ordinary tax rate, which is basically your tax rate for all of the income that you earn. So it's taxed at your ordinary income tax rate, but it's capped at 25%. So if your tax bracket jumps into the 30, 37%, that recapture is capped at 25%. So it doesn't, go all the way up there, but it could be a pretty significant chunk. Now, on the other side of that, the other portion is treated as capital gains, and that's taxed at either 15 or 20%. But there's a weird little additional thing called a net investment income tax. If you haven't heard of it, some people have called it the Obama tax. Some people have called it the Medicare tax, different iterations of it. But basically, when you have investments, there's an extra 3.8% that's tacked on to the capital gain that you incur. So while we believe capital gain is 15%, it actually is 18.8. While we believe it's 20%, it's actually 23.8%. So that's something that you'll want to keep in mind, because that extra 3% becomes fairly sizable once you get into larger gains. So that said, you won't, when you look at recapture being maxed out at 25%, and then your capital gain being maxed out at 23.8%, the delta between those two is fairly small, but still somewhat noticeable. So a lot of times you don't necessarily feel depreciation recapture, but you just have to know that it's absolutely there. And it's not just subject to real estate, it's any asset. The same would be true for vehicles or equipment or anything that you sell for a gain. It's likely going to be subject to depreciation recapture, as well as that additional net investment income tax.
awesome.
Does that help?
Thank you, Larry. Yeah.
Larry,
Yeah.
if you 1031, do you avoid the recapture and the capital gains?
I love that. Yes. And that's a great segue to what are some good exit strategies. So the 1031 exchange does allow you to avoid depreciation recapture. It also allows you to avoid capital gains. And the 1031, I'm assuming everyone knows what it is, but I'll just kind of give a broad elementary overview. You're basically saying, "Hey, I purchased this property, and now I'm gonna trade up. I'm gonna sell this property. I'm gonna take all of my proceeds and go buy a new property or properties that are of equal or greater value. And as long as I use all of the proceeds from the prior sale, and the value of the new property or properties is equal to or greater than my sales price, then I get to defer any capital gains from the sale of that old property." And what some people have done as a strategy is basically exchange, die. And what I mean by that is they exchange and constantly upgrade. And so they're after cash flow, they're constantly upgrading their cash flow, they continue to enjoy the tax benefits, then they do an exchange again and an exchange again. And when you get to the die part, that basically means that asset can now pass to the next generation, to their beneficiaries, and they receive what's called a step up in basis. So that basically means the fair market value of that property at the time of death is now the basis for the beneficiaries. So they could effectively sell that property either for the fair market value and incur very little to no capital gain, or just continue to do the traditional real estate play, refi, pull cash out, and continue to make investments. And so the 1031 tends to be a really good wealth building tool and a really good tool to avoid capital gains. Now, the drawback that most people suggest with 1031 is, oh crap, we've got timeframes we got to worry about. I'm not able to find property that makes investment sense, and so I feel like I'm forced to do things that I would otherwise not do from an investment perspective because of the 1031 rules. Well, in walks other opportunities to exit your real estate deal. Well, actually, before I jump into those, did that answer your questions about the 1031? Perfect. So in walks other opportunities to exit. Two of them, the initials for both are DST, and you probably heard of both. The first DST is a Delaware statutory trust. This is a great alternative or even a great supplement to the 1031 exchange, because basically it takes a commercial property that is already cash flowing and it allows you to exchange out of what you just sold into an underlying asset. And so different from rolling into a syndication or something like that, you actually have a pro rata percentage of an actual triple net lease type of a property. So it meets the 1031 rules. You already have predetermined cash flow. You don't have to go out and look for a deal. And so it's a great way to either, if you can't find a second deal to meet your 1031 numbers or your 1031 falls apart, the Delaware statutory trust is a great way to supplement that. It's basically a 1031, except the asset is already there. You don't have to search for it. You've got managers that give you the return and so on. The other DST is what's called a deferred sales trust. And if you're familiar with installment sales, this is basically a combination of installment sale and trust law. So basically what happens is I'm your end buyer and you're selling your property, and I'm just going to use $1 million example. You're going to sell me your property for $1 million. Before we commence the sale, you're actually going to sell that property to a deferred sales trust that's set up for $1 million. So you turn over title, deed, ownership, all of that stuff goes over to the trust. The trust now owns the property, but the trust doesn't have any money. So it hasn't given you your proceeds. And because we are what are called cash basis taxpayers, unless we constructively receive the money, it's not taxable in that given year. And constructive receipt basically means we have access and ownership over the money. If it's held in escrow, directly in our bank account, a check in our hand, we can control those funds. But remember, we sold it to the trust. The trust doesn't have any money, so the trust hasn't given us anything. So we don't recognize any immediate gain just yet. And then immediately at closing, or a week or so later, the trust turns around and sells that property to me, the end buyer. So the transaction comes full circle. I get the property, you've sold it, I've now written the check, and now the trust has the money to pay you out, right? And the trust does not have a capital gain because it bought it from you for $1 million and it sold it to me for $1 million, right? So we don't have to worry about the weird trust accounting, at least not initially. When you set up that trust, you set up a predetermined payout schedule. So basically you can elect to either receive your money in equal increments over 5 years, over 3 years, over 10 years, however long you want this to play out. It gives you absolute control over when you're going to recognize your capital gain. So let's just say you set it up for 5 years as an example, and it's going to pay you out $200,000 a year. Well, instead of paying capital gains on $1 million, you only pay capital gains on 200. Then next year, another 200, and so on and so forth. And so it gives you the ability to do some very unique tax planning. But here's the kicker also. The money does not just sit dormant inside of the trust. It can be invested. It can be invested in other things in other areas to continue to earn interest and or earnings, right? So at some point that's going to be distributed out to you. And yes, when you receive it, it is going to be taxable as income to you. But while it's held within the trust, you're not recognizing it until such time as you constructively receive it. So the deferred sales trust is basically a glorified installment sale, but it's also a checkbook to continue to go out and make additional investments and also control when you receive the capital gain. So that's one thing to consider. Or excuse me, those are two things: the Delaware Statutory Trust, the Deferred Sales Trust. We talked about the 1031 exchange. Another one is what's called a 170 exchange, and this is for those that are charitable or have ties to charitable organizations. The 170 exchange basically allows you to sell an appreciated property to a qualified nonprofit or charity. You're going to sell it to them at a price that's below fair market value. So you got this property, you bought it for $500,000, you've held it for several years, it's appreciated and it's worth $1 million. Now, you decide to sell the property, you're very charitable, so you're going to sell it to your favorite 501c3 down the street. But the fair market value is $1 million, you're going to sell it to them for $750K. When you do that, that delta between fair market value and the actual sales price, that becomes a charitable deduction for you. So you could effectively create a roughly $250,000 charitable deduction and or write-off, right? Now, and there are nuances in terms of how that flows into your personal tax return, but just follow me for the 50,000 foot view. That charity now has the property. You've now gotten the tax deduction and also fulfilled your mission for supporting organizations. And that's a good strategy because some people may look at that and say, well, why would I sell it and lose out on $250K of cash? Some people do so because they have a dog of a property that they're just trying to get out of. They're just trying to get rid of. They can't sell it or anywhere else. It's worth something, but it's a pain in the butt and they just have to get out of it. This may be something good to roll over to that organization to give them an asset that they could possibly either use and or sell. And now you've gotten out of it. Yes, it's below fair market value, but you also have a tax deduction on the side as well to the tune of $250K that you can use to write off against your other income. It's treated as an itemized tax deduction, the same way your property tax, mortgage interest, sales tax, and all that stuff is treated. So that's another opportunity to exit. And then the last one, before I'm going to yield here for some Q&A, is using what's called a charitable remainder trust or some type of charitable trust. It works very similar to the deferred sales trust that I just mentioned, except there are some additional nuances there. This appreciated property, before you decide to sell it, can be donated to the charitable trust. You've now gotten a tax deduction based on some future value of that property. So again, using the $1 million example, you don't necessarily get $1 million write-off, but future value that could be, future net present value kind of pulled back, that could be then roughly a $600,000-$700,000 write-off for you right away in this year. So you donated the appreciated property to the charity before you sold it. You now have a $600,000 or $700,000 tax deduction. The charity has the property. The charity can choose to sell the property or continue to cash flow, but inside of that charitable trust, you've created an annuitized payment based on those returns, an annuitized payment that comes back to you as a income beneficiary. So you got the tax deduction, but then you've also created another layer of cash flow. And yes, the money that comes back to you is considered ordinary income, but you've got this massive tax deduction to help absorb it, right? And then the charity essentially has this money and it can be used for whatever you've decided. It could be used at some point to be communicated or transferred over to support your alma mater, at some point to support your church or some respective cause. They don't necessarily receive that money until some point in the future, but you've gotten the tax deduction today. You've created lifetime income by way of an annuitized payment that comes back to you. Oh, and by the way, if your beneficiaries are mad because you just essentially gave away $1 million policy, you can use that money that's coming back to you that you're writing off anyway to purchase $1 million life insurance policy. So if and when you pass away, not only does the charity eventually get the $1 million that's inside that trust, your family now gets $1 million that you allegedly gave away to the charity. So all kind of comes full circle. So I know that's probably the fire hydrant. I'm going to pause there to see what questions we have about any of those exit strategies.
Yeah. Oh, sorry. Who was that? Someone can go first.
This is Xiaofeng. I have one question about the recapture tax. So the recapture tax is triggered when the property is sold. The sale, for example, year 5. What if there is some LP is leave earlier, like year 3? So does they still pay the recapture tax, or the remaining LP or remaining members in the entity pay all the recapture tax? Thank you.
You know, that is a good question. Not one that I've gotten before. And I don't immediately know the answer to that. I'll have to write that down and get back to you. So my thought initially is that if they exit the partnership early because the asset is still within the partnership, there is not going to be a recapture that comes back to that LP. They'll just have capital gains based on their basis inside the partnership. However, I don't think there's any. Yeah, let me follow up with you on that one and give you an exact answer because I'm not sure.
Thank you. The reason is one of the CPA mentioned that all the rest of the member who stay when they sell have to share all the bonus depreciation, which I think that was big difference.
Yeah, that's my initial thought in terms of how just logistically how it would work and how it would flow, which all of the other LPs then on some type of pro rata basis basically absorb that exiting partners portion of depreciation recapture because they left before the asset actually sold. And I'll have to look and see if there's any other type of accounting that needs to happen where that's not the case. Because essentially they're getting the depreciation advantage. They exit early, so they never have to deal with recapture. Let me think through that. I'll follow up with you on that one.
I have a quick question. So in the one example where you said you could, if you sold your property to a charity for like $1 million, or it's worth $1 million, but you sold it for $750,000, you have that $250K write-off. How is that carried forward? If you are not a real estate professional, of course, if you don't even make $250,000 in the year, but like what's the rules for how much of that you could take at any one time? If you're still maybe like working a W-2 or you're not a real estate professional.
Yep, absolutely. So a couple of additional things, and this is specifically called a 170 exchange, 170. So that 250,000, different from other real estate related deductions, that's treated as an itemized deduction. It's treated the same as if you had gone to Goodwill and written them a check for 250K or American Heart Association or something like that. So that goes on what's called Schedule A of your tax return. And the limits on writing that off is you're limited to 60% of your adjusted gross income. So said differently, if your AGI for the year is 100,000, you can use 60,000 of that 250K to offset your income. Now you only pay taxes on 40K as opposed to 100, and the remaining amount will roll forward to a future year until such time that you use it up. And there may be some changes to that where they put a limit on how far it can start to roll forward, but that's essentially what happens with that type of transaction. The other side is you sold it to them for less than fair market value. You've gotten the write-off, but remember your sales price was $750, so you also pay a lower capital gains tax. Whereas under normal circumstances, you would have paid $1 million, or you would have paid capital gains tax on $1 million, just kind of broadly speaking. You only pay capital gains tax on $750K because that was the sales price. So you got a huge write-off and deduction. You fulfilled your charitable mission, and you reduce your capital gains. Does that help?
Yep, that definitely helps. One other question too is, I am looking to sell a property where I will not have capital gains because, and we discussed this, I have lived there 2 out of the past 5 years, but I will have depreciation recapture. So is 1031 or one of these other strategies the only way to avoid the depreciation part of the recapture, even if I don't have the capital gains?
Yep. So in that case, because it's been transitioned over to an investment property, you can use the 1031 exchange, and then that will allow you to defer your capital gains tax, so or avoid your capital gains tax at least initially. But then you basically have to abide by the rules of the 1031, which is identifying the new property, identifying the new property, or up to 3 new properties within a certain time frame, closing on those properties within a certain time frame, which I believe is 6 months. As long as you can fall within that scope, then the 1031 would be a useful strategy.
Thanks.
Yeah.
Hey, Larry, quick question. By the way, I love this stuff. Really, really awesome. Thank you very much for your time here. If I'm using a 1031 exchange to avoid having to pay the capital gains and deferring the recapture, is there any implication on the way that I calculate depreciation for the new property in the future years that I bought with the 1031 exchange money?
No. I mean, your basis would essentially be your new acquisition price. And so your depreciation clock would start, or your depreciation number would start based on that new acquisition price. And then you can do the same strategy all over again, either regularly depreciate it over the normal useful life, or accelerate that depreciation, take that advantage, cash flow, and then continue to 1031.
Excellent. Thank you.
Yeah. And that's why it's been such a useful tool. And that's also why it was under attack. It may still, to an extent, be under attack with some of the proposals, is because that's just been an amazing way to basically, we have real estate, we cash flow, we pay taxes on very little, and then we sell it and do the 1031. We don't recognize any of the income, but we've upgraded to a bigger and better property with more cash flow. And by the time we get to the end of our life, we've now gone from what was initially a $250K investment to possibly a $1.5 million property that we can pass to our children. And that's generational wealth that basically has no tax implications, or very little, I should say. What other questions?
Maybe you could touch on any legislation from, any legislation coming down the pipeline that might affect us as like real estate investors on the tax side.
Yeah, that's a really good point. So there are a couple. I'm going to start with the 1031, and they've actually relaxed, on the 1031 than they were. They're not as aggressive as they were early on in the year. But what we will see is likely a limitation on how we use the 1031 exchange, especially for larger transactions. I do think that if your capital gain starts to exceed $500,000, and likely, certainly if it exceeds $1 million, then you are going to be limited on how much you can defer with the 1031 exchange. Doesn't mean it's going to go away. It just means that you can only 1031 a portion of your proceeds, not the full amount, which is going to be nuts just from an accounting perspective to constantly keep track of that. So we have to be aware that there are going to be changes to the 1031 for those of us that are dealing with larger acquisitions and dispositions. The other thing, for those of us that are in the syndication space, there is talk on limiting, if we work with accredited investors, there is talk on limiting what people can do with their self-directed retirement accounts. For example, recent proposal suggested that if an investment requires the individual to be accredited, then they cannot use their self-directed account to invest in that particular project, which for larger syndications, that's a problem, because you have tons of self-directed IRAs, 401ks, and different things like that. And if we're doing those 506C raises or even the B raises, and we require accredited investors, that's going to limit the pool. And it's also going to impact how we build wealth just from the investor side as well. So that's going to be huge. And then 2, I don't see there being changes to depreciation specifically, but I think there are going to be changes to accelerated depreciation, much like we talked about at the beginning here, that you're going to be limited on, at some point, you're going to be limited on being able to take the bonus depreciation at 100%. At some point, that's going to start to phase back. And so we'll start to see, I don't think real estate will become less tax favorable, but we just won't have the large write-offs that we've had before. But even with what's coming down the pipeline, real estate still remains a valuable asset to invest in, and a valuable tax advantage asset at that. If we don't have any other questions, I'll briefly talk here just on some very broad estate planning things that everyone should start to think about if you haven't ventured into that side just yet. This is a huge part of the presentations that I do, and I usually save it for the end because we talk a lot about building wealth, accumulating wealth, but we don't spend enough time talking about how do we then transition that to the next generation in the most tax efficient way. And so if you haven't done so, absolutely start looking at estate planning with your estate planning attorney and your CPA. There are 4 things that I think everyone needs to have, and I'll kind of go into details on a few of them. The first is a will. And the will is basically what I call the GPS, right? It gives the direction for how you want your things distributed and who they should go to. And if you haven't updated your will in the last 5 to 7 years, take a look at it. If you've had huge life events, a marriage, a divorce, kids, a substantial change in money, those are reasons to update your will. The second thing you want to have is a medical directive. Basically, if you're incapacitated and you can't make your own medical decisions, you want to designate who that person is. And I always give this example with my mom. She always says that, hey, if I'm ever on life support, don't let them pull the plug. Let God handle his business and do with it what he will. And I said, Mom, that sounds great. But if I'm not there, we got to have some paperwork that tells people I'm the one to make that decision. Otherwise, somebody else could end up doing that. So make sure that that's in place so that people can carry out your wishes. So that's the medical directive. And then the power of attorney is the same thing. It's one of those documents that say, hey, if I can't make my own decision, this person is the one that can make decisions on my behalf. And then the last one is a trust. And trusts get kind of complicated because they come in so many different flavors. And if you attend some of these webinars or even some of these workshops, you have attorneys and CPAs that will try to sell you a trust for just about everything. They look at you, Robert, and say, hey, you need a trust for your glasses so that we can protect those. So you got to be very, very careful with that. And so the foundational thing that I think every conversation starts with is a living revocable trust. And then things can get more complex from there, just depending on your situation. But I think just as a basic foundation, the living revocable trust becomes useful for everyone because revocable basically means you can make changes and decisions while you're still here. At the moment that you pass away, it becomes irrevocable and those changes can't be made. So you can move things in and out of it. And the trust is not necessarily a tax deferral vehicle, contrary to popular belief. The trust is basically where I mentioned the will is the GPS. The trust is the actual vehicle to distribute and get you get your assets exactly to where they should be going. So it allows you to avoid court and probate because you spent a lifetime accumulating assets. You don't want some random judge who's never met you a day in your life figuring out how to distribute your stuff to the people that you love and care about. And it also helps relieve some of that anxiety when these types of situations happen. And again, the trusts do get more complex. There are some trusts that are specific to tax purposes, but I think at the very basic, will, medical directive, power of attorney, and a living revocable trust kind of sets the foundation for your estate planning, and then you can get more complex from there. Any questions from that?
Hey, Larry, this is Josh. Thanks for the presentation. I actually had a question about something earlier. What are the rules and restrictions on getting into a syndication as a GP or LP using 1031 exchange funds?
Yep, so it becomes very complicated when you try to use 1031 exchange funds to roll into a syndication. Basically, you have to have a conversation with the sponsor, the lead syndicator, or the collection of GPs, because they have to structure it. And I forget the exact language, but they have to structure basically a tick for you, a tenant in common kind of a setup. And usually most syndicators are not going to go through that headache and that extra compliance if you're not bringing a significant amount of money to the deal either. And what I've heard from most of them is that, hey, I will have a conversation about it if you can bring at least $1 million or so to my raise. If you can bring more than $1 million, I'm willing to sit down and make these adjustments for you. But most syndicators, if you're rolling in, 5 figures or even 6 figures, like a couple $100,000, they're probably not going to entertain allowing the 1031 to roll in. And then rolling out of the syndication, like 1031 out of the syndication, the only way that happens is if the entire pool of investors decides that they are going to do the 1031 exchange. because the acquisition of the new property, that title has to match the disposition of the old property. And so you can't be an LP or a GP and say, hey, I'm going to take my portion and 1031 it. That is an entity level decision. So getting in via 1031, it's a conversation with the syndicators to see if they'll form a tick for you and allow you to do it. Getting out via 1031 is nearly impossible unless the entire collection decides that's what they're going to do.
Okay, makes sense. Thank you very much.
Yeah. Any additional questions?
I actually do have one really quick on estate planning. I know we're nearing the end of the time, but I'm just going to be real fast. So have you seen what type of distribution type of rules or restrictions have you seen clients put onto their, or if you know, put onto their trust as far as how and when they'll allow certain distributions to their heirs, just so that you try to protect it as much as possible so they don't just squander what you've built? Do you have any like major high level suggestions of what people have implemented there?
Yep, absolutely. So most people will do these restrictions mainly on their kids. And basically they lay out a schedule of when they can have access to certain benefits. And some people, I have some that are very educational based. They're like, hey, you going to school, you're not getting none of my money. So you have to go to school, you have to graduate with a 4-year degree, and you have to be in this particular profession. There are some that get that specific before the kiddos can have access to the cash. And some people set it up just based on age. So I have one client who said, look, if they haven't figured it out by 26, there's nothing that I can really do for them. And so they could have it and squander it, or they cannot. So that's it really depends on the individual and your personal philosophy on wealth and what rules do you really want to put around your kiddos. The other one that I've seen clients use a lot is what's called a irrevocable life insurance trust. That's also short for ILIT, ILIT. And those are those are when you have a trust, but the life insurance proceeds are distributed to the trust when you pass away. They're not distributed directly to the beneficiary. And then inside of that ILIT, you can then stipulate again how those proceeds are to be used. And that's usually beneficial. One, when you have a spouse that you don't necessarily trust with money, or two, you have younger kiddos that, if anything were to happen to you, the money would then go to whoever you designate as the custodian or guardian for your kid, but you don't necessarily want to give them $1 million, $2 million, or whatever the value of that policy is. So you can hold it inside of that life insurance trust and spell out those stipulations on how that money is to be used as well. And on the topic of estate planning, that ILIT, that life insurance trust, is a great way to move life insurance out of your taxable estate, because life insurance itself, as long as you didn't deduct it as a business expense, life insurance itself is not taxable. However, when they look at your entire estate when you pass away, they include the value of that life insurance in the taxable estate. And if that is the one thing that can kind of push you over the estate tax threshold, that could be a 40% mistake. So that life insurance trust is definitely one that you'll want to talk to the estate planning attorney about to make sure things line up appropriately. But short story long story short, you can put whatever stipulations you want before your beneficiaries access the cash. You can say, hey, you have to know how to do 5 backflips in a row in under 30 seconds. And if that's the rule, then the trustee has to make sure that that's the case before they distribute funds.
Okay, cool. I think
Awesome.
I like that backflip rule.
Perfect. Well, if we don't have any other questions, let me just wrap up by saying I certainly appreciate you all taking an hour out of your Friday to hang out and talk tax nerd stuff. I'm passionate about this, so I can do this all day long, but it's not often people give up an hour just to hear about taxes. And so I appreciate you all's time and some very, very phenomenal questions. Nicole has my contact information. And so if there are things that are very specific that we can't talk about on the public forum that you just want to reach out and have a conversation about, feel free to get my information from Nicole, and we could have a discovery call to go over your specific items and see what suggestions are out there.
Yes, perfect. I did put your website and email in the chat. I'll paste it in the chat again. But then anyone can reach out to me and I can also send it to you. But thank
Perfect,
you, Larry,
perfect.
so much. I really appreciate it. I'm gonna have to re-listen to this call because there are certain things that I feel like I need to hear again. Very valuable. Thank you so much. I really appreciate it.
No
Yes,
problem, no problem. Thank you all.
Thanks, Larry. Appreciate it.
Thank you.
Okay, everyone. Well, have a good Friday. See you later.
Thanks.
Awesome.
Yeah. Thank
Enjoy,
you.
guys.
Thank
Bye.
you.